Alright guys, so we have big updates today. We need to talk about Putin's terms for peace. Remember the talks in Istanbul? Apparently the Wall Street Journal obtained a copy of the peace treaty and we'll go through it. Then we have Russia protecting their state revenues coming from their energy sales. They have implemented a price floor to protect their earnings from Western sanctions. It's an answer to the G7 price caps. And the G7 diamond ban has gone into effect. Is this a game changer? Does it even make sense at all? Because the ban is likely easier said than done. But let's start with our main story today, which is the peace terms between Russia and Ukraine. And it's more like the terms that Putin imposed. This document is dated 15 April 2022, so it was after the Istanbul talks, after the negotiation facilitated by Turkey and before Boris Johnson came into the picture. Now, the overarching idea was to turn Ukraine into a permanent neutral state that doesn't participate in military blocs. The country would be barred from rebuilding their military with Western support, and Crimea will be under Russian control. These are three terms that Putin would push for if there's another round of talks today, so it's nothing new. But what's interesting is how Ukraine is permitted to join the Eurozone but not NATO. So there were some concessions from the Russian side as well. Remember the Russian point of view, whether you like or hate them. It's really important to understand their perspective as well. That's the only way we can eventually reach a peace settlement. The big threat has always been about NATO expansion, so joining the alliance would be unthinkable. Having foreign weapons would be banned on Ukrainian soil as well. And it's obvious what Russia's main concern is the fear of the West developing Ukraine to contain or even threaten Russia. So the majority of the terms was to guarantee Ukraine's neutrality, both on a diplomatic level and on a physical level as well. But this next part is extremely interesting. It tells you the plan to enforce the treaty. Foreign powers will guarantee the contract, including the US, UK, China, France, and Russia. So if the treaty was violated by either Ukraine, Russia, or any other party, this council will be responsible for defending Ukraine's neutrality. But if the treaty is held, the guarantors will need to terminate any agreements that compromise Ukraine's neutrality. And this shows the level of skepticism Russia has towards the West, and it's very likely the US couldn't swallow the terms. Having Russia and China on the council is unthinkable to the US or even the UK. Any action could be blocked by them, and that might escalate to another conflict in a worst case scenario. And if we look at the situation today, the West has clearly rejected them through their actions. The NATO chief has reaffirmed that Ukraine will join the alliance. According to Stoltenberg, it's not a question of if, but a question of when. And whether Article 5 gets invoked or not, having Ukraine in NATO is a red line that Russia would never accept. Joining the EU for economic reasons is very different from joining NATO, which is a military alliance. So there are big fundamental disagreements between the West, Ukraine, and Russia. The Istanbul documents just confirm we are further away from peace than ever. And these aren't opinions, it's simply looking at the facts on the ground and drawing obvious conclusions. Turkey is offering to host another round of peace talks. But until the West can agree Ukraine won't join NATO, this will be useless. The Russians will never agree to Ukraine in the alliance. That is a big red line. But let's talk a bit about the Russian economy. The conflict is going to continue and war is a very expensive affair for both sides. Is Russia going to collapse tomorrow and burn down? Now, firstly, it's undeniable that trying to block Russian oil from entering the global markets has completely failed. If we look at the weekly crude oil outflows leaving Russian ports, the latest data shows 16 million tons exported in January 2024, and this puts it well above the average of the previous 3 years. The majority of the flows went to Turkey, China, and India, but that shouldn't be a surprise. But what's interesting is how exports are rerouted away from the G7 and EU countries to other buyers consistently. And at this point, any further embargoes from the West can't really do further damage. That experiment has been done and it has failed. But why did it fail? Because the shadow fleet transporting Russian oil is growing fast. Just 5 months back, over 70% of ships transporting Russian crude were so-called shadow vessels, and this means Russian oil can be bought above the price cap if bench crude rises high enough. It's obvious that Russia refuses to sell their oil at $60 a barrel, but buyers don't want to buy oil at a market price of over $80 either. So the shadow fleet provides a bridge between these two prices, while of course making the shadow vessels a handsome profit. Not only are China and India making money, but these shadow fleet are making good money as well. It's just a transfer of wealth from the West to them. Now, while it's true that Russian oil is sold at a discount, it's starting to narrow. Indian companies importing Russian oil are enjoying smaller discounts with each passing month. We can see the discount to Brent crude close month after month, going from nearly $20 to under $5 discount. This means one of two things. Either oil is being sold higher at the port of loading, which means Russia, or shippers are jacking up the cost. They are passing it to the buyer, and many of these vessels are Russian ships that directly contribute to government revenues. It's not a coincidence that the US imposed secondary sanctions on Sovcomflot, Russia's biggest tanker group. That means any US assets the company has could potentially get confiscated and it can't do any business with America any longer. But there's still a loophole here. The tankers can still ship oil to China or India, which can get refined and then ship out to the rest of the world, and that includes the US and the EU. The only guaranteed way to destroy Russian revenues is to sanction the biggest buyers of Russian crude, target the Chinese and Indian companies directly. That is the only option left. India's Minister Jai Shankar has reaffirmed their commitment to buying Russian oil despite the sanctions. He reminded the West that India and Russia share stable and friendly ties, and Moscow has never hurt the interests of India, so trade relations aren't gonna end. And if you look at the entire geopolitical situation, the US can't afford to sanction India, and neither can they sanction China as well, unless they want a bigger economic war. So we are reaching the limits of punishments on Russian oil. If these secondary sanctions or shipping companies fail, that's likely the end of the line. Now, of course, Russia has their own set of tricks to protect their revenue, and they won't go down without a fight. And as a major oil producer, they do have some leverage in the game as well. Russia is suspected to use a price floor to counter Western sanctions to protect government revenue. The key is to keep the amount of taxes from Russian oil companies to the government consistent. Wars are very expensive, and Russia wants a predictable stream of income into the war chest. And to do that, they are introducing a $15 price floor on euros discount. That is the basis for calculating oil producers' tax. Because of Western sanctions, the discount for Russian oil can be really volatile. This can make government revenues very unpredictable, which is bad for budget planning. This could result in further deficit spending. While the discounts on Russian oil are normalizing, there can still be initial shocks when the G7 imposes sanctions. In February 2022, the big discount came when sanctions were first introduced. The second drop came when the price cap was first imposed 10 months later. What Russia is trying to do with a price floor is to guard against further external shocks. The G7 has tightened their sanctions enforcement a few months ago, so the discount of Russian oil has started to expand once again. Sanctions on Russia won't end anytime soon, so the price floor idea is to ensure revenue coming in is very predictable. A price floor is rather simple. If the market price of Russian oil falls down to $60, but the floor pegs euros at $65, oil producers will be taxed at $65. The burden will fall on the producers. Either they negotiate a higher selling price with all their buyers, or they pay the outstanding tax with their own profits. Russia's trying to close the discount gap while making sure their war chest is still being filled up. So we are starting to see Russia fighting back on sanctions using their domestic supply. This chart shows us how the price floor works. The black line is the market price of euros, Russian oil. The yellow bars are the prices calculated using the price floor mechanism. So if times are good and the discount narrows, Putin will tax oil producers based on a higher price, the black line. But if the discount widens and the price drops, Russia will tax profits based on the price floor, the yellow bar. In January, we can see the price floor exceed the actual market price of euros. So taxes will be imposed based on $65 and not 64. And this is essentially the plan to keep government revenues consistent. That allows the war machine to keep chugging along. Now the G7 might have a lot of tricks in their bag, but Russia isn't helpless either. This economic war isn't going to end, and Russia is starting to innovate their methods to protect their income. And over the next few years, this discount floor will continue to tighten. It will go from a $15 discount to $6 by 2026, and that will stabilize government revenues even more. Now, how will the G7 fight back? I have no idea yet, but the old playbook isn't working. It's back to the drawing board for them. And let's touch a bit on the G7 diamond ban. No, this won't destroy the Russian economy. At least to me, it's more symbolic than the actual punishment. As of today, the Western diamond ban is in effect. The G7 and the EU are starting to clamp down on diamonds coming in from Russia. And here are the details in a nutshell. Rough and polished diamonds entering the EU and G7 nations like the US will have a new restriction. There must be documentary proof and declaration that the stones aren't from Russia. and from September, a mechanism to trace the origins will be added to the system. Now, this sounds grand and groundbreaking, but whether this will work will be a whole different matter. The diamond trade is even more obscure, more opaque than oil. Trying to trace them will be extremely difficult. A diamond is like gold, it's elemental, and this means you can't use any scientific method to determine if the stone is from Russia, Australia, or even a conflict diamond from Africa. It's virtually impossible. It's very different from oil, right? You can trace the origins of oil back to Russia by analyzing the composition, like the sulfur content and specific gravity. It's not possible with diamonds. The only way to trace the diamonds is from their origins, when the gem is still rough, and that is at the start of the supply chain. But after that, it gets very unclear. The cut and polished stones are often intermingled at trading houses, and the documentation becomes one of mixed origin. The key here is how will they enforce this? Forging a piece of paper isn't difficult, and the declaration can always become false. And if the West goes all the way, this will impact countries like India and the UAE. India is home to 90% of the world's cutting and polishing industry. By enforcing this, you'll be hurting Indian companies directly, which impacts their economy. But if you want to clamp down completely on Russian diamonds, you have no choice. You need to target India. But will they? This is the big question. This will just piss off New Delhi even more. And let's war game this out and assume that the West is 100% successful in enforcing a diamond ban. Let's just assume zero Russian diamonds enter the West. Will this really collapse the Russian economy? In 2021, Russia brought in $4.7 billion from diamond exports. If exports to the West drop, revenues will indeed drop. But even if it drops to zero, even if Russia gives away all the diamonds for free, it's nothing in comparison to the oil trade, which is over $100 billion. The West has to make a decision. Is it worth it to clamp down on a few $1 billion of trade to anger countries like India and the UAE? Now they absolutely can, but this will just result in a bifurcated market for diamonds. Prices will get cheaper in places that still import Russian diamonds. Places like China, India, and the Middle East will still sell diamonds at cheaper prices to their domestic market. Russian diamonds simply can't enter the West, but there's no problem in entering the East. This price difference will cause buyers to flock to Asia, to the Middle East to get that diamond ring or necklace, or pay much more in the US or Europe. It's basically shifting trade away from the traditional diamond hubs to the East. Now, the biggest buyers of Russian diamonds in 2021 was Belgium, an EU country. But just like oil exports, discounted Russian diamonds will flow once again to Asia and to the rest of the world. They will pick up the drop in Western demand. And this clearly shows the desperation to target every single revenue channel. But the effects will once again boomerang back. It will result in higher prices for the West. So if you're in the G7, prices for diamonds might be heading up. Diamond inflation might be coming really soon. But let me know what you think. Are the G7 sanctions working? And will the diamond ban even work? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.